Hi, good evening all, and thank you so much for joining today's exclusive webinar on Contra Mutual Funds. My name is Ashish Asthana, and along with me to do this exclusive session, we have called up Mr. Amit with us, who is coming from Invesco Mutual Funds, right? And we will be discussing in detail about this Contra Fund, what is its importance, what is the portfolio all about, and definitely it will be followed by Q&A. So any questions you have in your mind, you can keep it, you can post it across to it. Post that, we will be taking live Q&A session as well. So Mr. Amit, we welcome you on our show.
Thank you.
And over to you, sir. Please, you can throw some light on this Contra Mutual Funds, its importance, and how it's going to be helpful for the investors.
Okay, thanks. Good evening, participants. Thanks for having us here. What I'll do is I'll briefly take you to the Contra Fund presentation. That's the latest presentation which has basically been published by Invesco. That presentation will basically give you a brief flavor of what Contra strategy is all about, how we manage this fund, what's the portfolio positioning. When I cover the positioning, I'll also briefly cover market outlook because funds are supposed to be managed based on the market view that we have. And in the end, I'll leave it open. I'll keep the forum open for Q&A. Any specific question, either on Contra Fund or on markets, you can ask. I'll be glad to answer. So as far as Invesco India Contra Fund is all about, if I were to describe this fund in one single line, then this is nothing but a multi-cap fund with a value bias. Why I say multi-cap fund with a value bias, because if you look at the strategy over last many years now, in 1.5 years ago, SEBI created a separate category for value. Since then, basically, it is part of the value strategies. But internally, the way we have always treated this strategy is that this is a flexi multi-cap, which means it can move between large, mid, and small. But while it's a multi-cap strategy, the way it differentiates itself as compared to other multi-cap strategies is that it has a value bias. Now, how do we ensure that there is sufficient degree of value in this strategy? For that, the most important thing is that whenever we are buying any new company into this strategy, there is a preference for certain type of companies. Now, which are the type of companies that the fund prefers to buy because of its value bias? So the first type of company that we prefer to buy is companies in a turnaround phase. Now, which are those companies that we call companies in a turnaround phase? If you look at the current portfolio, companies like Axis Bank, Bharti Airtel, Sun Pharma, Apollo Hospitals, United Spirits, ABFRL, these are all the companies which have been bought purely because we expect them to turn around. When I say turn around, what it means is that whatever is the top line growth, your EBITDA growth is higher. Whatever is your EBITDA growth, the profit growth is even higher, which means that if you get it right, investors who are invested in these kind of companies get benefit not only of earnings growth, but a meaningful benefit comes out of PE rating as well. As we speak, around 24% of the portfolio belongs to these kind of companies. The second type of companies are companies which we call, they are trading below intrinsic value. Now, in this category, generally the type of companies which are preferred are companies which are cheap based on either price to earnings, which means that it's earnings based cheapness, or you buy companies cheap based on price to assets or price to book, which means that the replacement value cheapness. Now, if you look at the portfolio, almost 19% of the companies belong to this category, but within that also, company like HCL Tech is a company which is cheap on price to earning. SBI is cheap on price to book, and SBI also has SOTP, which means sum of parts, which means there are subsidiaries which are continuously creating value. Bharat Electronics is cheap on price to earning. BPCL is once again cheap on price to book. Tata Steel will be cheap on price to book. So it's a combination of companies which are cheap either on a replacement value basis or they are cheap on a earnings basis. The third type of companies that the fund prefers to buy is what we call derated growth companies. Now, many times, good companies otherwise doing well, they do derate, and sometimes the derating can be purely on account of technical reason. Now, in 2012, HDFC Bank derated, 2014, HDFC Bank derated because FIIs could no longer buy. So as a result, that was a good opportunity for a strategy like Contra Fund to invest into that company. Now, last 6 months, because auto volumes were down, Maruti derated. Recently, because of Once again, auto volumes being down, companies like TVS Motors, whose previous high was 700 rupees, derated to as low as basically 340, 350 rupees. IT Web, Hexaware is another, decent growth mid-cap IT company, but it derated last year. So sometimes, even growth companies which otherwise are doing well or basically, delivering. Another example of derated growth company is Infosys. Now Infosys, because of whistleblower complaint, everything else was fine, but it's just that there was a whistleblower complaint, and this was a technical reason, maybe a short-term technical reason, but it still corrected meaningfully, and that became an opportunity for a strategy like Contra. As we speak, 27% of the portfolio belongs to this category. So if you add all these three categories together, almost 70% of the portfolio is invested in what we call undervalued or turnaround or contra names. Uh, what we commit to our investors is at any point of time, at least 60 will be in contra. Why 60 will be in contra? Why not 100? Because company's life cycle changes. At one point of time, we had ICICI Bank as companies trading below fundamental value. But in last 2 years, ICICI Bank has re-rated. See, the important thing to understand is that Contra's objective is not to avoid growth. We actually want to buy growth, but we want to buy growth when it is in the value phase of its life cycle, which means that once that turnaround happens, that value company ultimately becomes growth company, which means that you benefit when it becomes growth, which also means that, and as a result, Contra will always have companies which today are not Contra. But that is okay. We want that to happen because that is our success. But what happens over a period of time is that we buy when it is value, we enjoy when it is growth, and we exit when it becomes momentum. Last year in August, Maruti touched 10,000. We used to have a large exposure. We completely exited because we thought that, at this price, the risk reward is completely unfavorable. But at 6,500, we once again re-entered because now it's a derated growth company. So this is nothing but, in simple words, like a life cycle investing. You buy companies, good quality companies available at a reasonable valuation, wherein the value phase of their life cycle. You wait for things to turn around. Once those turnaround happens, you enjoy when it becomes growth company, and then you exit once basically you think that risk reward has completely become unfavorable, and you exit when it becomes momentum company, and the same money then can be utilized to buy other contra ideas. So that is how basically the cycle works, and that's why 60-40 is the ratio. But as we speak, as I told you, it's not 60, it's 70% of the portfolio which is basically invested in undervalued companies or contra companies. The other thing that this fund basically does is also, we do pick sectors based on what we think is, good contrarian sectors or sectors which basically, can benefit our investors. Now, as of now, our house view is that India will have a cyclical, turnaround because the economy basically is in shambles. Economic outcomes have been very weak. Base effect for many sectors is basically, quite favorable. And so to that extent, there are three domestic cyclical sectors in India. All three we think will basically play a role in India's turnaround. First sector is basically consumer discretionary. The second sector is financials. The third sector is industrials. Now, within these three sectors, as we can see that Contra Fund is overweight in industrials, Contra Fund is overweight in consumer discretionary, and we have a small underweight in financial. But if you add these three sectors together, weightage in Contra Fund, we have almost 55% exposure to the cyclical sectors. That way, this strategy is quite pro-cyclical in nature. Now, why this kind of strategy? For two reasons. In India, because economic growth has been weak, the sectors which are cyclical in nature are also the sectors which are attractive in terms of valuation. So they become natural, bets for a strategy like Contra. The other important thing is that as and when economy recovers, it's the cyclical sectors, who can turn around and who can basically provide that earnings bounce back. See, when economy turnarounds, HDFC Bank may still continue to grow at 20%. It was anyways growing at 20%, which means that the delta to earnings does not come if HDFC Bank basically, however good HDFC Bank does, because it was anyways doing good. The delta to earnings starts to come when SBI basically starts to turn around. And to that extent, the valuation delta today is more maybe available in SBI as compared to HDFC Bank. So this is just a small example. And that's why cyclical sectors are very, very important for Contra strategy right now, because they are available at attractive valuations. At the same point of time, they can provide that significant turnaround in terms of, earnings. Apart from that, because the strategy is Contra, it's not that, in search of cyclicality, we ignore something that is cheap. If you look at Contra Fund, it is today overweight on utilities. Why? Because utilities as a sector is cheap in terms of valuations. We are also overweight IT. Why? Because IT, we had invested significantly 2 years ago when it actually was Contra. Today it is no longer Contra, but it still acts as a good defensive. As I told you that Indian economy is still basically, not in a very, very great shape. In that case, if something goes wrong further, this is one sector which provides a good hedge and the valuations are still reasonable. If you compare IT to FMCG, the ROE profile is same, but the valuations are much, much cheaper. On top of that, healthcare also is an overweight because there also pharma companies have derated quite meaningfully and today look attractive from a risk reward perspective. So these are the 4 5 sectors which basically Contra Fund is overweight. And as you can see, one common theme that ties all the sector together is one, that the earnings get turned around dramatically, and second thing is that the valuations are attractive. The third thing that this fund does over a period of time is, as I told you, it's a flexi multi-cap. A flexi multi-cap strategy will have the ability to switch between large, mid, and small. In last 1 year, as you can see, because mid-cap, small-cap valuations had become more attractive, this was one of the few strategy which actually ended up increasing weightage to mid-caps and small caps. So if you look at the overall exposure, our large-cap exposure went down from 71% to 68%. 3% change if you look at year-on-year basis, but if you compare from October last year, then large cap exposure actually went down from 75% to 68% basically in one year, 3 months. Now whatever change of mid cap, small cap weightage that happened is now benefiting the fund, because those changes basically were made when mid cap, small caps were very, very attractive in terms of valuations, and now the fund is benefiting because mid cap, small caps have started to see some sort of re-rating. What we tell our investors is that our mid cap, small cap weightage does not get determined on a top down basis. So we don't decide how much mid cap, small cap we want to own. It's just a matter of incremental valuation. So if mid cap, small cap are attractive, you will find automatically Contra's weightage to mid cap, small cap will go up, and if large caps are attractive, Contra's weightage to large cap also automatically goes up. So that is how the positioning of fund basically gets decided between mid cap, large caps, and small caps. Now if you do all these things right, uh, one of the most important characteristic outcome is that the portfolio PE, if you look at it on FY21, is actually lower than the benchmark. Your earning growth is higher than the benchmark. And remember, we are not basically achieving these outcomes by compromising on quality. Why do I say so? Because if you look at the portfolio ROE, the ROE is actually higher than the benchmark or in line with the benchmark. And it's not today that the return on equity is higher. If you look at one of the slides where we have provided the overall return on equity of the portfolio, historically also Contra Fund return on equity has always been higher or in line with benchmark, which means, see, sometimes in search of value, one of the big mistakes that investors make is they basically compromise on quality. If you do that, then there is the biggest risk to value is actually value trap. How to avoid that value trap? Always focus on quality. How to ensure that the portfolio quality is high? You have to actually ensure that the portfolio return on equity and return ratios are strong. Cash flow basis, the portfolio basically should be strong. If you look at the history of Contra Fund, one of the reasons why our value style has basically not done quite well over a long period of time is we never compromised basically quality for the sake of cheapness, and that is visible in the portfolio ROE. Now, if you look at the outcomes that the fund has generated over a long period of time, what we always tell our investors is that this is a 3-year product. Why this is a 3-year product? Because on a 1-year basis, this strategy may or may not outperform, because if you are buying a lot of contra ideas today, for first year they may continue to track. But if you look at 3 years, 99 points. So if you look at 3 years, we look at 5 years. So in 3 years, 89% of the time the fund has managed to beat the benchmark as well as peer group average. If you look at 5 years, 99.7% of the time basically fund has managed to beat the benchmark as well as peer group average. And when I'm saying basically 5 years, I'm talking about 5-year daily rolling. See, this is a this is a strategy which is a very long-term track record, almost 12 to 13 years. Now in last 12 to 13 years, whenever investor has invested on any particular day, and if he has remained invested for 5 years, 99.7% of the times he has basically exited by making very, very reasonable returns, because the average returns is around 15.85%, and he has managed to beat the benchmark also quite handsomely. So I think that's the main attribute of this fund, and that's why value style makes sense. Right now as we speak, the asset allocation strategy that we are recommending to the investors is that, see, if you are investing either in value or in mid caps or in small caps, the reason to invest is recovery. And if recovery is something that you want to benefit from, then actually some doses of lump sum investments are required. SIPs are good, they may help, but if you want to enhance your IRRs, then some degree of lump sum in addition to SIPs that you are doing is very, very useful, is very fruitful, because it will help in enhancing the overall IRR. So that's the asset allocation recommendation from Invesco at this stage. With this, I'll close my discussion on Contra. I've briefly covered market outlook as well when I was covering sectors. In case there are any questions regarding market or regarding Contra, I'm happy to answer. Thank you.
Great. Thank you so much, sir, for such a wonderful, insightful knowledge. So viewers, now we are open for Q&A. Any questions you have, you can post. You have a question mark icon on your screen. Just press it and you get the screen, keypad open. You can type in your questions. Right. So many questions we are getting. How can I place order online? So let me quickly share my computer screen and show you how simplified it is to place order online. For that, you have to log on to our website. That's www.hdfcsec.com. Click on login, enter your login credentials. And this is how the home screen will look like, which is our Empower Trading Portal, right? You can simply go on mutual funds, whether you want to do a lump sum or a SIP, you can select the relevant option, select the scheme which is there. We have bifurcated into need-based analysis, into aggressive, moderate, conservative, and ELSS. So as per your requirement, you can select the scheme and you can do the investment. However, if you wish to see the reckoner right here, you can see this option of download report. If you click on download report, out here you can see this mutual fund reckoner which has been provided by our research team, and here you can see the scheme details and you can search that particular scheme in the get code page and you can invest. In fact, whether it is through laptop or a mobile app, it just take about 2 to 3 clicks to start your investments. All right. So first question we are getting from Mr. Ravi Shankar. He is asking, why is the name as Contra?
Yeah, so the name Contra basically is for historical reasons. See, Contra basically, I mean, technically means going against the market. Honestly, we don't adopt that kind of strategy. The strategy that we adopt is a value kind of a strategy. There was a possibility at some point of time in the life cycle for us to change the name, but we opted not to do it because, see, Invesco Contra Fund is basically, emerged as one of the strongest brands for us.
Right.
And because the brand was strong, we thought that, why not to basically, create the differentiation, because generally, many other contra funds in the past have not done well. Our contra fund basically has consistently done well. So to that extent, we thought that, why not to continue with the distinction as, one unique contra fund which has done well. Otherwise, we don't specifically follow contra strategy. We actually follow a value-oriented strategy. And when I say value, basically contra is one of the styles, which basically is part of value. So value is like a mother kind of a strategy, and subset of that would be contra, subset of that would be turnaround, subset of that would be deep value. But overall, what we adopt is value strategy.
Value strategy. All right, great. Next question we are getting from Mr. Saurabh Makin. He is asking, what is the highest weightage you will give to a particular stock in the portfolio?
So, see, SEBI does not allow us to go more than 10% in any particular stock, but in Invesco, one of the house rule that we follow is that every stock that we want to own has to be overweight. Which means that now if Reliance has basically 6% weightage in the benchmark, if I like that company, I'll at least own 6.5 or 6.25, and to that extent the weightage there would be higher. But on the other hand, United Spirits has no weightage in the benchmark. Our 2% weightage in United Spirits basically creates almost 2% overweight. So we generally instead of looking at the absolute weightage, we go by overweight, underweight. In general, if I really am very bullish about company, very comfortable with the business, and very happy with the way it's basically performing right now in terms of the results, then 3.5% overweight position we don't mind. For example, ICICI Bank is right now the largest overweight for us. It has been overweight for some time now. We are almost 3.5% overweight. So right. Benchmark weightage is almost 6%. We are at 9.5%, and we don't mind that kind of weightage because benchmark weightage itself is quite high. So the absolute weightage basically on an absolute basis, while we not cross 10, but at the same point of time we ensure that there is a decent overweight position that we have.
All right. So next question we are getting from Mr. Rahul. He's asking, I'm very new in mutual funds and stock market. How can I earn from this? Mr. Rahul, just for information, if you have not first of all, please let us know, do you have HDFC Securities account or not? Right? If not, do you have HDFC Bank account or not? Let us know. Right? Whatever may be the case, you can simply log on to our YouTube channel. Just type in HDFC Securities, and there you need to select the playlist, a playlist of webinars. So in this, okay, so you have HDFC account, great. So what you can do, you can simply log on to the playlist of webinars. There we have taken a complete session on what is mutual fund all about, because if you ask me, mutual fund itself is a very vast and diversified product which not only deals in equity but also in debt, and the mix of both, wherein we can have equity hybrid, we can have debt hybrid schemes as well. So the entire know-how of mutual fund, what is that all about, and how you can begin your investment journey, we have done an exclusive video is available there, which is a recorded session of one of the live session we have done it. So you can watch that. Just you need to scroll down, I think maybe around, at present, more than 250 videos are there. So you need to scroll down a bit more on the webinar playlist, and definitely you can find out there, and you can start your investment journey. So moving on, let's see the next question. So again, an interesting question coming from Mr. Ramya. She's asking, what is recommended, SIP or lump sum for this? How it makes difference, and what is the minimum amount for investment we can focus for?
So generally, see, if the investment is for recovery, which is what we are pitching right now. Right now, the focus of this fund is to basically benefit from economic recovery. And during times of recovery, actually, lump sum makes more sense. Even a 50,000 rupees lump sum is basically good enough. It can add to your overall whatever SIP that you must otherwise be doing. So if you add to that, it basically will ensure that your overall IRR basically gets enhanced, because lump sums done at right time and in a decent manner basically enhances the overall IRR. So the thing is that the difference between lump sum and SIP is that SIP is more like an averaging kind of act, which means that you keep on averaging your cost of buying. But if markets keep on rising, then the average cost keeps on going up. On the other hand, if markets basically are falling, then your average cost keeps on going down. Since I told you that this is a product which is suited, which is basically positioned for economic recovery, and since it's a recovery for which I am pitching this product, lump sum basically makes more sense than SIP at this stage, because if the NAV keeps on going up, then your SIP will basically, the average cost will keep on going up. So I think lump sum is better, but even a 50,000 rupees lump sum is good enough.
Great. Okay, a few more questions we are getting, that we have missed out the earlier session and we have joined in late. Can I watch the recording? So yes, the answer to that is, of course, you can watch the recording. Recording would be available on the same link after about an hour's time. So just you can click on the link. If you're watching it from a mobile, it won't open on a GoTo app, because app is to watch the live webinar so that you can interact with us. Simply open it on your mobile browser, maybe Chrome or Safari, and you will be able to see the recording. However, the same video would be available on our YouTube channel in a couple of days time. So through that, through YouTube also you can watch it. But yes, the recording would be available right away after an hour's time. It will be uploaded on the same link. Okay, interesting question coming from Mr. KS. He is asking, can I get exemption under Section 80C in income tax?
No, for this Contra Fund, you cannot get exemption. For that, you have to look at, you have to search for the category ELSS, and within ELSS, basically whatever funds basically are recommended, you can invest. Those funds basically are eligible for 80C, exemption under 80C.
So I think there are no further questions. Thank you so much, viewers, for joining in, and thank you so much, Mr. Amit, for such a wonderful session that you have taken us for all our investors today. It was really great, and I wish all our viewers have a great day.
Thank you. Thanks a lot.